You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Graeme Körner from Körner Perspective, Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on X at Business Day TV using hashtag Stockwatch. Gents, thanks for the time today. Grant, let's start with you. Let's start with the good news story that came out a couple of hours ago. Local inflation for March, 2.7%. We've got an MPC meeting in little over a month. Surely we're going to get, I don't know, MPC's careful, maybe only a quarter, but it feels like there is, even in a wild, uncertain time of the world, space for a rate cut.
Now, look, there's definitely space. But the DNA of our Reserve Bank is they are intrinsically hawkish and conservative. And I'm not sure they can overcome their instinct, which is not to cut because of the uncertainty. But I agree, there's plenty of room. Look at the Rand petrol, oil price. Inflation forecasts are being downgraded by some of the big banks, and the outlook is, so the view was we're sort of hitting a low and we're going to pick up in the next year or two. That is being reset lower given all of the potential slowdown and the oil price, etc. So I'd love to see a cut. I think we desperately need of it. We tend to follow the US. I think in the absence of improving prospects of cuts there, which there probably are, to be honest, my betting would be against a cut, but I do think we'll get one sometime this year, but I'm not putting my money on the next meeting.
Yeah. Okay, that's the May meeting. Maybe a June or heck even later, but by then we're deep in winter. Hey, Graeme, AMPC, they are hawkish to their absolute DNA, and they are resolute, I suppose, in their process. We've got massive high real interest rates, but we've had that for over a year now.
Yeah, I think Grant's probably on the money. Unfortunately, personally, I think there's lots of room to cut, because if you just think, we will follow the Fed, and I think the Fed's going to hit the pause button. But if you look at where their interest rates are anchored and where our rates are anchored, and our inflation rates are not that different, really rates are very, very high in South Africa. So I think, I don't want to say they're behind the curve, but because they are just really cautious, and I think they're worried about inflation coming into the system. But just on the, if you look at the data points, and they always say they're data driven, the near-term experience is we're below the lower end of the band. I think there's scope to cut, and I really pray that they do, because I think the South African economy, you've seen downgrades, the IMF downgrading us to, what was the percent, I think?
Yeah.
At the beginning of the year, lots of people were saying, well, 2. Now, but I think I agree with Grant. I think in their DNA, they are very hawkish, and I wouldn't say they're afraid of the unknown, but they definitely err on the side of caution.
Yeah, and the IMF coming in saying we're going to do 1%, Treasury saying 1.9%, a fair disconnect there. So let's go to the horror story. 5 p.m. yesterday, Aspen put out a SENS announcement. Didn't say much. Had a press conference this morning at 8 o'clock. Again, didn't say much, except that they have lost they're losing a contract, going to cost them around some 2 billion. Graeme, not a lot of information in terms of who, what, or why, which is perhaps what matters. The bigger story, perhaps, is it's Aspen again, I almost want to say.
Yeah, Simon, I think, the old saying rings true in Aspen this morning, and that is that the market hates uncertainty more than bad news. So, they've basically thrown the kitchen sink. They say 2 billion rands worth of, dispute, plus the impairment of the IP around that. So, and it's going to take time to fill that capacity. So I think you're on the money. The market has taken somewhat of a jaundiced view of management in terms of the promises of execution. You just sort of got the feeling in the last year that maybe, the building blocks were in place, PE coming online, maybe an entry into the US, and volume-based pricing obviously hurt in China, but lots of optionality there. So you just kind of felt, the story was getting better, and it was moving into a delivery phase. And then, this comes, and it knocks the stuffing out of the market's confidence in the management team. You understand it's a complex environment. They operate in 100 countries. the science behind this in the pharmaceutical industry is highly technical, and it's way above my pay grade. But the reality of it is the market really, disgusted with this update, and I think it's more simply because we have to assume the worst. And yeah, it opened about 30% down, and it's been trading there. I just said to some colleagues earlier today, although it's dire, somebody out there sees value. At lunchtime, over R1 billion had traded. So somebody out there feels that there's a story here in spite of all that uncertainty, but very disappointing. And I think it's going to be in limbo until we know, what the nature of that dispute is. Is it just a shot across the bow? Is there maybe a break fee payment coming? Until we get clarity on that, this thing's going to remain very, very somber.
Granted, is that clarity. I mean, they've got great facilities, but we don't know if the problem is perhaps with their facilities. It's that lack of clarity, lack of uncertainty. Is this just a stock that for now we stay away, leave it alone? Or is there, as Graeme says, if there's R1 billion traded, there was R1 billion of buyers?
Yeah, I mean, hopefully they weren't short covering those buyers. So, no, look, I think, remember, they're also talking about impairing some of the manufacturing facilities, which that in itself is a concern because it suggests it's maybe not just the contract, maybe the ability to fill that capacity is being in question. And the whole investment case for renewed upside in Aspen was around utilizing this excess capacity that they've built, this beautiful facilities. They haven't been using them to their maximum. And the idea was as they start to expand that usage, the margin will come with it, the growth will come with it, and there's your upside. But that story's been in play for over a year now, and so there's been a lot of promises made. And again, it feels like overpromise and underdeliver is what's happening here, and that does knock confidence in management. The company has a reasonable amount of debt, so the questions, the pressure there, the questions could be asked there around what does that mean for that position on that balance sheet, and where does the growth come from? They had recently had some FDA. They failed some of the FDA standards in their manufacturing facility, the sterile facility, and I think it was the PE one. That wasn't a good sign. I'm not sure if that's related, but these kind of things are a bit of a concern. I would stay away. I certainly don't think there's enough here to. There is still a business left. It's not like there is no business. This is not Steinhoff, but certainly the risk around trying to understand what's the right price and what are you buying has escalated dramatically, and probably best to stay on the sidelines for now if you don't have a position.
Yeah, it's that not sure, and that's at the heart of it. Just not sure what, where, how, or anything. So let's move on to Capitec results. Question came through late last night saying surely Capitec, whilst expensive relative to other banks, looks attractive. Results out this morning. Grant, Capitec doing perhaps what it does best, knock it out the park. I mean, not a cheap stock, not sure it's ever been, but 30% HEPS growth.
High quality and growth doesn't come cheap, Simon. So the stock will never be cheap if they continue to deliver. So if you're waiting for cheap, you're going to have to go look at Absa. It's a phenomenal company with an incredibly innovative culture, and they continue to deliver. They've really created a platform rather than a bank. So you see how they continue to overlay new value-added services into this 20-odd million client base, this platform, and the way they see this business that they've created is very different to the traditional banks. The others are trying to play catch up, but I think they are doing a remarkable job. I think to deliver 29% return on equity leaves huge room for reinvestment back into the business. It's a great story. I think there's more to come. I don't think you should wait for it to get cheap because you won't own it. Much like Clicks, it'll get cheap when everything else gets cheaper. So you'll always see it as more expensive of what's out there as long as they continue to deliver. I think it's one you should just have in your portfolio. Growth in South Africa as a whole is hard to come by. So when you do find growth that's reasonably reliable and persistent, you should at least own that in your portfolio.
Yeah. Graeme, you often refer to the PEG ratio, earnings growth, PE. They're both at around 30. This tells you we've got a high-quality growth stock that is, frankly, on a PEG of 1, which is not overly onerous.
No, absolutely. But I would also say that, as the earnings growth rate goes up, arguably a one peg is maybe not is no longer attractive because the reality is it's difficult to sustain 30% earnings growth. And I think, so for me, I think the counter view to that, and I understand the optionality of the client base, but I do think that if you look at the incredible progress that somebody like Time Bank has made, for example, and you've got Bank Zero, the competition is coming in this space. And I would argue that somebody like Time has got a very, very good footprint, and with what they've got in their team, I think they can also offer competition. So I think right now, Capitec is top dog. They're growing. They've got the client base that they can sell into. My only anxiety is that the traditional business model needs to morph quite significantly into other things. I'm talking about the traditional banking business. And that's not going to be at the kind of margin that they've enjoyed in the past. So, yeah, I think the reality is a 30 multiple for me is just too rich. You can buy, 3 of the 4 big banks on that multiple. It's too rich for me. But I understand the short-term appeal. I would rather if you don't hold it, just sit it out. But I've been wrong on this for quite a while.
I take your point on that. Graeme, next stay with you. Question coming through Spar. It's no ShopRite, but cheaper. Starting to get things right. SAP is now working. Exiting Poland. Is it worth looking at Spar? Would you be looking at Spar as almost the sort of like a lagger in the space that could perhaps get some catch up?
Not really. I don't. It's a different model, so I don't think you can compare Spar to ShopRite. To me, Spar is almost more of a logistics company than it is a pure retailer. So my sense is the base is low, and they hopefully won't score as many own goals. But if you're looking for quality and you're looking for the visibility, ShopRite really are in a league of their own. For me, the turnaround right now is probably more in Pick n Pay, because they've really been thumped really low. The base is pretty low. So I think the recovery potential is probably more in Pick n Pay than in Spar. But respectfully, I'm not really drawn to either Spar or Pick n Pay. I think if you want to be in that space, there's a big argument against, from my point of view, of betting against ShopRite.
Grant, I mean, ShopRite absolutely is the gold standard there. Would you look at some of the sort of, if you politely call them second tier?
Sure. I think Boxers is well positioned to continue to grow and compete with ShopRite in its niche, of course, not in ShopRite's whole business. I think Spar is interesting because it's cheaper. So I think, they're not yet delivering amazingly well, but there's a few things they can do to improve the business and capture some kind of upside, some kind of re-rating. Just bedding down their market share and stop giving up market share to ShopRite. Get rid of Sweden. Hopefully they'll exit that. That's been a drag on the business. Focus on what's core to their business and what they do well. So I think there are some wins available to them that will help that performance. But already I would like to have seen more of that. So I buy the self-help story there. I think there's the risk reward here is in your favor, but it may just be a value trap. So the answer is yes, I would look at it here. But I think one needs to just be awake to that it's not a given, it's not a gimme.
It might be that horror value trap. Grant, let's stay with you. Question coming through on Sasol. Sasol makes oil from coal. Why is the oil price, or petrol, why is the oil price then important? It's just a factor of, I suppose, it's what they're selling at, and it gives them a base. Of course, these days, chemicals are a lot more, also highly important for Sasol.
Yeah, exactly. So they still have quite a high correlation to that oil price and the rand oil price in terms of their earnings. But I think it's 50% of the business is chemicals related, as you said. They've got the European and the Lake Charles in America. And then they still have the energy related operations, the coal mining that they feed into the refining. So yeah, I mean, it is still, if oil price rallies from here, Sasol will probably rally with it, despite all the noise around that. And a lot of the chemical, the margins are related to, oil through the nat gas, the cracker, and so there's like correlations between the various parts of the business and the energy price, even though it's not a direct, okay, I'm selling oil today. So it doesn't dislocate completely from this.
Graeme, if oil's the important point, and I mean, I see that oil has bounced, although this was this week 5 years ago that WTI went negative, which I think freaked everyone in the market, certainly freaked me at the time. The case for a stronger oil is not that strong in a world where IMF is downgrading growth.
Yeah, very much so. So I think and also in an environment where Trump wants America to pump oil like there's no tomorrow.
Yeah.
So I think that, and in a world where EV car penetration elsewhere in the world 30 to 40%, some places in the world significantly higher than that. So you can actually see a world where demand is not sort of perfectly correlated to what GDP does into the future. And I think as Grant said, the reality is that the refined price of petrol or diesel is a function of what the oil price is doing. If you put a constant margin on, and of course, remember they do hedge out in oil as well. So absolutely, I think if the oil price were to move by 5%, Sasol will follow suit. I think it may actually give you a kick of performance right now. I mean, if you just look at it in terms of what the forecasts are, this thing is it's obscenely cheap. It's on a PE of like 2.5. But clearly the market doesn't trust it, and there are other questions around CO2 emission fines and stuff like that I think would also question it. But I mean, for a betting person who wants to take a bet on oil and you only got money in South Africa, Sasol is probably a nice way to play that.
Let's move offshore to a degree. Question coming through around Naspers, looking to get some China exposure. There are some ETFs, but is Naspers worth having a look at? Graeme, of course, Naspers 10-cent process. They still majority China. Process has got some food delivery as well. Would you be looking at Naspers or perhaps process at this point?
Yeah, but I think if I may, the question's kind of got two parts. One, sure. What do you think about Naspers? And the second question around China. If you look at, for example, if you've got money offshore to put into China, you could look at something like the CSI 300 tracker. iShares has got one of those. In fact, we hold some of them. And you can get local trackers to give you Chinese exposure as well. So I think there's if you take a 5-year view, there's a strong argument in favor of Chinese equities at these levels. But yes, I think in terms of Naspers, it looks compelling because you're buying 10-cent at a let's call it a double discount. So that looks appealing. But if you're looking for broad Chinese exposure, remember 10-cent only represents a few percent of that index. And there's some other things. Obviously, some of the financials, particularly the banks, cause a little bit of acid reflux for me. But I think the reality of it is that I think Chinese equities look quite interesting. It's not going to be smooth sailing by any stretch of the imagination, but Naspers also looks appealing. But I wouldn't put the two together, if that makes sense. Yep. Naspers makes sense, and if you like China or you want China, don't just go and buy one asset.
Okay, I like the logic of that. And then Grant, I mean, is China that a space that is attractive to you, and then more narrowly, would Naspers? I mean, there's obviously lots of options there. Would Naspers be on that list?
Yeah, yes to both. So as Graeme said, 10-cent's a great business. You're still getting it cheaper than any of the US large cap tech, and it is a high quality business. It's pretty removed from all this tariff trade war noise because it's really inward focused. And remember, China's the second biggest economy in the world. It's growing, even if it slows down, it's still growing in and around 4%, which is multiples of most other major economies. So the prospects for earnings growth are still very attractive. The valuations are still relatively cheap compared to especially the US. So would I have a China exposure in a portfolio with a longer term view, 3 to 5 to 10 years? Absolutely, I would.
Question coming through around Afrimat, nasty trading update. Should I be worried? Grant, we kind of knew this was coming. This is the Lafarge integration, I imagine. Your take on Afrimat? The trading update was weak, but I don't think it was a surprise, perhaps.
No, so I missed this trading update, but I will say that I like the management of Afrimat. Yes, there's some digestion in that Lafarge deal and taking on that business, but it is a business they know and understand. So I think they will bed it down. That's the one. And the second one is the iron ore business is under pressure given the freight and given some of they sell internally to some of the ArcelorMittal operations. So they have got some pressure there that is outside of their control. And I'm not sure if they've alluded to that in the trading statement. I remember that from the last update. So I like the business. I think there's some challenges there, but if I had to take a longer term view, I would still be comfortable looking at something like Afrimat on that basis. It is cheap, and the cycle. Historically, they've been pretty effective at getting things done. This management team.
Graeme, I mean, so Afrimat's one of those stocks where every time it goes below 50, I think I should buy some, and then I don't, and it rallies up to 60 or 70. Is it attractive at that around that 50 level, which is more or less where it's back right now?
We don't own them, but I think the story is good. I think the digestion of Lafarge is one thing. I do worry a little bit about the iron ore market. There's some pretty big iron ore projects coming online, which I think have the potential of knocking iron ore prices down $20 a ton over let's say, the medium term or short to medium term. And that doesn't augur well for that part of the business. But if you believe the forecast, it's, I think, R7 worth of earnings, then it should be a sitter at 50 Rand. So I think on the back of that, I would argue yes, but there are going to be some challenges, I think, in parts of the business. But I think, as you both said, management have done an amazing job at navigating what's actually a very difficult environment. If you think of where they come from, let's call it an aggregates business way back when, and what they've actually managed to assemble and how they've navigated through a really dull GDFI sort of construction environment in South Africa. So, clearly a management team that is able to execute.
Yeah, they show that chart every result season without the acquisitions as Afrimat listed and with, and it is chalk and cheese. We've got a few minutes before stock picks. Blue Label hitting 52-week highs. South Sea seems to be working well. Graeme, Blue Label, it's not one I follow closely at all ever since they went into South Sea.
Yeah, you and me both. I think as the other operator, it's going to be tough. It's looking a lot better, but I think they were very brave to take that on. That's not one that I have a strong view on. I'd probably just sit it out.
Yeah, I've been sitting it out and I'm happy with that. Let's go to stock picks. Grant Nader, you're going with Steve Madden, which I was smart enough to know are shoes, but that's kind of where it ends. Tell me why Steve Madden is interesting.
It's an interesting company. It's fallen by more than 50% since the trade war, so for the year. But it's got a long track record of doing a great job, of executing well, of being very trend aware in their fashion, and successful. They've pitched at a good price point. They're kind of in the Zara type of price range. So I think they've got a good niche. They've got a very strong brand awareness. They're growing well in SA. Out of interest, they did make a note to say that South Africa was their fastest growing region. I like the company. I think the entry point is really attractive. So it's been hit hard on the view that the majority of their production comes out of China. So there is that exposure. But these guys, and I speak for all of these companies, they have a way. The supply chains will diffuse to the rest of the world very quickly. They'll be in Vietnam or Mexico or wherever they need to be in a year from now. Most of this tariff issue will be resolved, or tariffs will be lower than what's currently being announced. And these kind of businesses will give you a real upside trajectory, some nice cyclical upside in terms of returns. So you're getting it at a really good entry point. It's a good business with a good brand, strong balance sheet, no debt. So I think it's an exciting opportunity if you fancy a bit of excitement in your portfolio.
Yeah, and some fancy shoes. I don't know any of those brands beyond the Steve Madden, but Graeme, you're keeping it nice and simple. 91.
Yeah, so just for context, 91 has got, I think, 130 billion pounds of AUM, translates to about 3 trillion Rand. That's a proper business, and it's been quite steady. They obviously lost some mandates when people obviously went to cash and others. But although we've been in a really difficult market, if you look, the FTSE is up. Most of the US indices are still up on a 1-year view. So for me, you're buying, I think, a really well-run business that's very, very geared to markets. You're getting call it an 8% dividend yield for your troubles. A little bit of movement in the equity market, if they were to achieve a couple of mandates, then suddenly this thing becomes, gives you really decent earnings growth. So for me, you're being compensated with a really attractive dividend yield. And of course, most of those assets actually sit outside of South Africa.
Yeah.
So it's a kind of a roundabout rand-ish play as well. So I think the bottom line is I like the geared market plays right now. They give you optionality and you're being compensated even if the earnings don't grow over the next year. I think you're getting better than you're doing on cash.
Yeah, 8% is a chunky yield. That's all for Stockwatch today. Thanks to our guests, Graham Körner from Körner Perspective going with 91, Grant Nader from Benguela Global Fund Managers going with Steve Madden. Up next to close, stay watching.